Good afternoon. Good afternoon, everybody. So you can have a seat if you're here for the venture capital panel. Come on in. So good afternoon. It's great to have you all here. This is an incredible time for the venture capital industry. Our industry is on the front lines of the AI revolution with all the founders that we back. So there's so many insights to share about what's happening in the world of tech today. Today's top venture firms deliver both a compelling return profile, but also consistent with the theme of FII Miami this year. We do so, I think, with purposeful impact. But there are also challenges in our industry today. There's so much competition, prices are sky high, there's lots of hype. So we're going to sort through some of both the opportunities and the challenges in venture capital on this panel. So with us we have Pejman from Pear VC, Vinny from Left Lane Capital, Charles from ARK Investments, and myself, Ben from Village Global. Vinny, let's start with you. What's the top reason why you're really optimistic right now? We'll talk about both positives and negatives right now in venture and tech. Let's start with points of optimism. What gets you really excited to dedicate your life right now to venture in this moment in the tech evolution?
Well, what was everybody investing in 5 to 10 years ago in the US VC and growth industry?
What was everyone 5 years ago?
Yeah, 5, 10 years ago. What was everyone investing in?
Enterprise SaaS, crypto, bio, software.
Yeah, maybe crypto, but enterprise software.
Yeah.
Enterprise software was 80, 90, close to 100%, depending on the firm you were at, of what you were investing in. Our industry became cowards, right? We became simple-minded. We became, okay, what are the four numbers? Invest, past, invest, past. And that's okay, because we learned consistency. But because that has now been shaken to its core, we're becoming brave again, out of necessity.
So just pause for a second. So hold the mic a little closer so we can all hear.
Okay.
And so it took us 1 minute, and we've said the industry was cowards.
Yeah.
Keep going.
No,
the industry was
now,
cowards 5 years ago.
Now we've been forced to be brave again.
We've rediscovered bravery.
Yeah. So when I look at our last couple of years of investing, I see companies like 7th Street Burger in New York City or Blank Street Coffee. What? Why are we backing burger chains and coffee chains? But then I also see companies led by this Gen AI revolution that are, we were talking earlier about a software company in our portfolio that sells to mechanics. And they're getting mechanic shops to pay 50 grand a year for expertise and replacing a non-existent employee when they never would pay more than 3-4 grand a year for software. So suddenly we're going outside of this walled garden, and we're going into, some people who are really brave are going into defense, right? We're going into food and consumables and all kinds of things like that, but we're also going into the services economy.
So is this basically the story that technology is touching every industry and software is eating the world, and so now the total opportunity set is just so much larger than it used to be? Is that the idea?
I don't think software is eating burgers. I think humans are eating burgers, and that's okay too, right? I think
but
that
you're investing in a burger company because there's some tech growth dynamic, no?
No, it's a good business, right?
Interesting. Okay.
Like, it's a burger shop.
Yeah.
But they're profitable. They break even quickly. The company's growing fast. And the reason why is because when we look at public markets, they don't give software companies a halo anymore. They're just valuing companies if they're good or not.
So Charlie, what categories are you really excited by? What tech trends most give you optimism right now in venture?
Sure. Well, speaking with ARK, sometimes I feel the need to be pathologically positive, which is the opposite of being cowards. So we're definitely seeing a bigger future. We think very long term. I think the positivity is really important because I think that's actually the reality, right? Is we are heading for a much better, more productive future. We actually just published an annual Big Ideas report that encouraged folks to read, but the reality is GDP it is the norm that there are massive changes in GDP growth through time. There was an enormous lift, obviously, with the Industrial Revolution, electricity, those kinds of things. We see a future where GDP growth could hit 7-ish% for the coming years, which gives you an enormous global GDP of over 200 trillion, in the 2030 total time frame. I think, love the love the when needs must, turn our back on cowardice. I do agree there's a war footing. That's one of the big changes I'm feeling.
There's a what, a war footing?
A sense of a war footing.
Okay, what do you mean by that?
Both specifically and around defense, and then generally around nobody knows what's happening, so we have to take big, bold, courageous bets, and nothing is off the table. Like, I think there is a very real belief, probably more than I've ever seen in my career, that everything we now rely on could be completely overturned in 2, 3, 4 years' time, which we've always believed.
So give us an example of one or two areas that you think could be completely overturned in the coming years.
So I think subscription-based SaaS could completely disappear. So, you know, over the last few years, we've realized, like, what's attractive for a human to do this and get some benefit, and then, you know, we've all got tens or even hundreds of these subscriptions, $2 a month, $20 a month, $50 a month, whatever. There's a world where all of that goes, or at least 90-something% of it goes, because we know what's attractive to a human, but guess what? In a 2, 3, 4 years' time, we're already seeing it. It's not going to be humans making the decisions. It will be agentic AI talking to other agentic AI. You will have hundreds or thousands of agents out there on your behalf making all of your economically meaningful decisions, and you'll just be at the top of the pyramid.
And this is you, like, so you're running your household, like you're living your life as an individual human you're talking about, and you have your AI agents deciding which magazines, just, you know, like your Netflix subscription and your house cleaner and all that kind of stuff. Is that what you're talking about, like at the level of the individual?
I think it's more that you climb the iceberg, right? And more of the iceberg just goes under the water, and you're just at the very top saying, you know what, I just want an amazing holiday. I want to have a suntan. I want a margarita. It's roughly between July and August. Figure it out. And the agent will go and get you the best. You know, that's one example, right? But what we've seen, and, you know, if you read some of the AI papers, some of the science fiction is coming true, right? These things learn languages of their own that we don't really understand when they interact. And we're just beginning. It's the nascent time. So they will learn, like, what does, you know, we know what, you know, the kind of SaaS version of ice cream with a cherry on top, something attractive looks like for a human. We've got no idea what that is for agents. It's probably some blend of, like, efficiency, low cost, et cetera, but it depends what their objective function is.
And so, Pejman, we'll come to you in a sec, but just, Vinny, just on enterprise SaaS, we were talking off stage about what VCs sometimes say in private about the future versus what they maybe sell LPs. What's your view on the future of enterprise SaaS as an investable category for venture?
So I differentiate between infrastructure software and application software. Picking on application software, my first 5 years of investing when I was at Insight Partners, it was all application software, really. And some of those companies, for very specific reasons, basically because what they do is uniquely hard to build, uniquely high trust, they're going to be able to go a handful more years without feeling the pain from this. But the companies that are selling into sales or marketing, the companies that maybe are nice to have, they have shorter sales cycles, behind closed doors, every growth stage software investor will tell you their portfolio is suffering. And it's suffering because the North Star metric, the net revenue retention, has fallen off a cliff relative to what it used to be. And it's because the per seat pricing is not relevant in an agentic world.
Because customers are switching to AI native options.
If I price based on 100 sales reps and you go to 0 sales reps, how the heck does my pricing work? And they can't afford, the incumbents can't afford to switch away from per seat pricing because that's where their pricing defense comes from. And then what I wasn't expecting, which is competitors are popping up every single week from 3, 4, 5-person teams who built so efficiently with the most cutting-edge AI development tools that we never expected to just suddenly have someone offer our exact same product at 1/10 the price. And the example we were talking about was ZoomInfo, where ZoomInfo was hit especially hard by this, and then they keep getting kicked while they're down because at one point the net revenue retention was 120%, and then it dropped to the 80s.
So the future of enterprise software and enterprise SaaS, which has been for so many years sort of the foundation of so many venture firms and the returns that they've delivered to LPs is really under threat, is something I think the two of you would agree on.
It's completely under threat.
So Pejman, let's talk about the venture landscape more generally. You know, something that's happening in our industry is there's this sort of barbell effect where you now see firms like Andreessen Horowitz and General Catalyst raise multi-billion-dollar funds and really become asset gatherers across lots of product lines. Then you see folks that stay relatively small and focused. Groups like Pear, groups like Village, focused on the seed stage part of the ecosystem. Talk about your decision to stay small and focused and how do you see it playing out over the next 5 to 10 years in our industry?
Yeah, I'm going to point the previous question, but before I realize I have the same jacket. I promise I have more jackets at home. So, so I just want to talk about why I'm doing what I'm doing. I think it's a privilege and honor to partner with entrepreneurs who are going to solve real problems, create companies, create wealth, and create jobs and change societies. And the second reason is financial reason. There's no industry in the world that you can get 1000x of your investments. And the technology has shown that you can invest and get 1000x. There is none. I actually, when you look back, technology has enabled us to have better lives. I don't think we can imagine lives without Google and DoorDash and Uber and so on. So I actually think historically, venture. I agree with you, Charlie. I'm very optimistic. The changes today is AI. I actually think AI is everywhere, and there's a company called Cursor is allow people code, like editor for codes. They went from 0 to $100 million with less than 20 people. So you're gonna in 1 year, in less than 1 year. So you're gonna see creation of multi-billion-dollar companies with limited number of people. So
and also maybe raise less venture money.
Of course, that's actually a very good question. Companies used to go from 0 to 1. When 0, you come to us and raise pre-seed and seed, and then at Series A, an inflection point, and you go raise money in multi-stage firms. If your company works and you have true product market fit, you go from 0 to thousands. So the importance of how you find these entrepreneurs, how do you provide services, how do you build a brand that you can track the best talent in the world, it's a question for me as founding member of our firm. So,
and I do think this raises this interesting dynamic. Like there's the Sam Altman line of, it won't be long until there's a company worth $1 billion that has only one employee, right? If folks heard this. And so there's kind of this dual reality, which is on the one hand, there's so much optimism, AI's eating everything, there's so much opportunity to put money to work, but also maybe the companies aren't going to have to raise as much money as they used to. So the question is like, how are the GCs and A16Zs of the world going to deploy multi-billion-dollar venture funds if Cursor can go from 0 to $100 million of ARR with just 20 employees? Like, are they just not going to raise? They're going to raise $20, $30 million and go public. Why do they need the multi-stage?
Well, I can speak of Andreessen Horowitz and others. I'm focusing on finding the next Cursor. So we build, as you mentioned, how we stayed so focused. So we build a firm that we are pre-seed and seed specialists. That's all we do. We see 12,000 startups a year. We build software internally to look at them. We build a team who have been founders. We never hired investors. We have a team of 4 senior recruiters. Still, we don't see some of these companies. So I think today's world, entrepreneurs demand more. And if you're building a long-lasting venture firm, you have to build things that they want.
So Vinny and Charlie, what do you think about what's your take on the what's happening in terms of fund sizes in these large platforms?
I think if I could come in on, I think there's a really interesting dynamic towards this hyper-efficient company that's generating massive value, having spent fractions of, just a couple of sort of narrative exemplar. I recently had a couple of pitches from, one company that had built on top of an LLM stack and had just been paid $5 million for a consulting-like project from another consultant, I don't know, like one of the big 5, to do something for them that they would have outsourced, and it would have been $6 or $7 million if it had been humans doing it, and they delivered this result. But he said, the guy was like, I shouldn't tell you this because I'm pitching you to, I'll tell you this as I'm pitching you to invest because I want you to invest, but I probably shouldn't tell you this because I would also like to partner with you and do work with you. But that piece of work that I just charged $5 million for cost me $5,000 in GPU cost. And
so he charged the customer $5 million and it cost him out of pocket $5,000.
$5,000 and took him, like he said, under a day, whereas it would have been a multi-month consult. So just as an example, of course, that sort of thing may or may not, that just may be a temporary blip, right? But to your point about the sort of billion-dollar one-person company, I think we are starting to see that. In terms of, I think it gets at a really core question that actually we don't know the answer, like nobody knows the answer to, right? Like it's kind of related to the DeepSeek question. It's, are we heading into a world of commoditization where lots of models can essentially do all of the economically useful stuff and it becomes cheaper and cheaper and cheaper? I also had another pitch recently.
Sorry, are you analogizing DeepSeek and AI models to the venture industry generally in terms of Like, does our asset class become commoditized?
I'm saying, yeah, does this all become so efficient in the limit that it all kind of the deep seekification, right, happens of everything, where you can't deploy the money. People only need to do one raise or they just do organic growth because it's all so cheap and you can deliver such value. Like, that's one world. Or the other world is more the Stargate kind of world, where it's like actually you get such insane new emergent capabilities coming from giant models that we can't even imagine yet, right? Like what happened with GPT 3.5 into 4, like the GPT moment, that surprised everyone, including Sam. And we're quite big investors in OpenAI. We did 250 million into the last round, and we're very excited about what OpenAI is doing. You know, it may be that a lot of this stuff happens and people build these layers that are somewhat agentic and some of them get commoditized out, and it's very efficient, and that meets most of what we consider as the economy today. But there's a whole new economy that happens that we can't even imagine yet because we don't know what the emergent capabilities are if you do like an XAI scale or a Stargate scale thing, because it could just be so
So is this
disruptive.
kind of a binary split where there'll be some companies that raise just massive amounts of capital, and then there'll be a bunch of companies that raise like one round and done, 10 million max?
I think we're seeing that. Or Midjourney is a good example, right? I'd love to put money
Midjourney's
into
good.
Midjourney.
Yeah,
They won't take my money. I've had several conversations.
Yeah. Pejman, do you want to say
I think every time OpenAI, Anthropic come with a new model, thousands of startups die. But at the same time, I think there are people from certain industry that use AI to tackle the problems that particular industry, and I don't think OpenAI, Anthropic go after that. I'll give an example. We just invested in a company that use AI to make heavy machinery in oil and gas and other industries smarter and faster. I don't think OpenAI goes over there. You use OpenAI, go over there. So while I believe that these models getting smarter, faster, better, there are opportunities in other industries that you can leverage AI and build moat and build massive companies.
Vinny, you can comment on this, but also what's something you believe that a lot of VCs would disagree with you on, or what do LPs get wrong when they think about allocating to venture capital? Pick your poison.
I think I'd rather answer the second one.
Go for it.
I mean, most of what they get wrong is just, and it's funny because they also say this when you're speaking with them one-on-one. It's like, yeah, we're very backward-looking. Right? We read all the most cutting-edge stuff, and then we look at the last 10 years. And you're almost guaranteed to miss the mark when you do that. Right? You looked at the venture capital returns for 10 years, and once they got too good to ignore, you piled in, and what happened? The market crashed. And then what did you do? You pulled out. And then they'll start going back up again. So that's the classic.
And so I totally agree. And we talked to a lot of LPs about this lagging indicator versus leading indicator dynamic, which is LPs tend to look at lagging indicators, but the past is not a perfect predictor of the future. Some things compound in venture. Like there is a brand moat that can build around some firms. We would argue at Village there's a network moat that firms can become more valuable over time as network power compounds. But actually many firms don't have a moat, and I would argue, and they can lose value over time as the GPs become more and more busy and harder to attend to new deal flow. Pejman, do you have something on this?
I don't have anything different than what venture capitalists think, but I think we always forget one thing, that there are only 10 to 20 companies created every year that matter, no more. Can you be in one or two of them? Since 2009, our team looked back at this. Since 2009, there are only 9 companies have been created that have a public market over $50 billion in tech at the end of 2024. Think about it. These are tens of thousands of companies, only 9. So are you able to find the best?
But if you're an allocator evaluating a venture firm or trying to understand the asset class,
yes.
What are the leading indicators you look for to determine that this firm has a better than average chance at getting into one of those 8 or 9 companies?
Yeah, I actually think LPs make the same mistakes that I do. You don't spend enough time with the founding team to understand who they are, why they're doing it. They just look at few decks and they come and look at your numbers and you can IRR, ended up. The mistake is we do. Sometimes we look at a deck, we don't get to know the founders deeply. Why are you doing it? What is the history you have? I think LP does make the same mistake.
Founder satisfaction or founder NPS is a pretty good leading indicator, I think, on the eventual long-term strength of a franchise. Charlie, what's something you think LPs or GPs get wrong when thinking about venture?
I was going to take the second half of your question, the other side, if I can do that, and I'll come back to LPs. The thing I believe and have witnessed, I think, live in the work we do, that I think maybe runs against the grain of ventures. I think it's really important that VCs can invest, that being a public-private crossover fund and being able to start a position even in either side is really, really important. And I think part of the reason is, the dislocations in value we've seen in the last couple of years in this volatility period have been absolutely incredible, especially in things like some of the deep techs we look at, like in biotech, where in 2022 you had a historic number, I think it was over 250 of negative EV biotechs, some of whom had cures that were either approved or late or clinical, and they were about to come to market with like a 5 to 10 year market exclusivity. I mean, it's insane, and it was largely because of all the algo-driven trading. So that's a great opportunity, and we have about 80% private, 20% public, but having the ability to do that public-private arbitrage is massively helpful, I think. In terms of LPs, I think probably in LP discussions generally, I mean, we have an orthogonal pool of capital actually. So we have our fund is open, or part of our fund is open to non-accredited retail investors. So we have 15,000, think of it as like micro LPs in that category, and they have liquidity through an interval fund structure. So maybe I'll talk about that later on. But I think in terms of more the traditional family office and institutional LPs, I think it relates to what you said. Despite the evidence, for instance, that emerging managers generally take the biggest risks, get the best returns, there's always this kind of, the venture LP equivalent of no one gets fired for hiring Goldman Sachs kind of thing, which means that you've got this Pareto concentration again and again in these big names.
Yeah, the funds that actually deliver outperformance are like emerging managers that are small in scope, but they're so hard for LPs to sift through that they pile money into the IBM equivalent. One threat, we talked about a lot of opportunities in our asset class. One challenge that many people think about in venture today are entry prices. So I was doing an event recently with one of our LPs who's a billionaire tech founder who was saying that when he raised his pre-seed round for his now public company, I think the valuation was $5 million entry price, and he was a really seasoned, excellent entrepreneur. If that round was being done today in 2025, that'd be a 25, 30 million post-money valuation. And so when you 5 or 6x the entry price for investors, you have to believe, I think, that the exit prices are going to be so much higher to deliver the same kind of return to LPs. When any of you think about your fund models, are you modeling larger exits? And if so, what gives you confidence in that? Or are the overall return in the asset class they still be compelling, but just a little smaller than they used to be?
So I'll tell you how we model. We take whatever the cost to acquire a customer is, and we multiply it by between 3 and 4x in the whole period. And then we take whatever the public comps are today for your business, regardless of what we're paying on the way in, and we cut them by 30 to 40%. And then if your business can still make it through that model, you have a fucking amazing business. And if it can't, you might still have an amazing business, but we won't invest. But we're dummies, so we just dumb it down.
And then I guess, Vinny, when you think about overall return, like during the peak ZERP moment, I think Zoom was at like 70 billion and Roblox was at like 100 billion. These crazy about do you underwrite today thinking that, the next generation of Zooms in this AI world are going to be 70, 80, $100 billion companies? Because that's how a lot of firms in peak ZERP, a lot of venture firms were justifying their entry price by saying, no, 100 billion is the new billion. Right. That's what the exits look like today. Do you believe that, or do you think it's more like PagerDuty-like outcomes for most of the companies you invest in, which is a great business, $3 to $5 billion public market company?
Mathematically, it's more the latter, which is why ownership matters so much to us.
So despite the AI revolution, we're not going to see...
We might.
Okay.
We might. But just, based on the 9 companies or, 10 to 20 companies a year matter, mathematically, the majority of the 15 companies a year that we back are not going to be the $100 billion company.
Yeah, I actually think it's a very good question. I remember I was the first investor in Dropbox. The pre-money valuation was $3.75 million valuation. You don't see that today. But we built a program at Pear called Pear X, which is a boot camp for ideas. So we have twice a year we do that. We select 15 to 20 teams. Each one gets $500,000 to $1.5 million, and we opened the biggest AI studio in San Francisco. So we require them to come over there. Think of YC, but only for 15 to 20 teams. So I looked at the last 2 batches. Our average check is $670,000 for 10%. So we see really good quality teams early on. Obviously, some of these AI companies that raise between $50 to $100 million. Yesterday was at $30 billion, super intelligence. We don't touch those things, but I think we built a lot of muscles and sourcing to see these companies early.
Charlie, you put $250 million into the last OpenAI round. What do you think OpenAI's terminal value is, or what do you underwrite that investment to? Because what was the valuation of the last round?
157 in the post. Billion.
157 billion post money. So
156.
where does OpenAI get long term?
Look, I think I've heard intelligent people say it's 10x undervalued, and intelligent people say it's 10x overvalued, and they're probably none of them are
Smart
right.
people disagree. A good mantra for the venture industry.
Look, I think
You think 10x? Do you think there's still 10x from here?
I think I could imagine that and more. I mean, the thing is, OpenAI is a real company. It's doing multiple billions in revenue, over nearly 4, and actually it's probably raised again, gone up even quicker. We've got a model that could do 10 billion in revenue this year. So it's a very real company. That's a very big difference. This is not .com like kind of craziness, or maybe it's crazy, but it's not the same. It's a real business.
The good kind of crazy versus the bad crazy.
The good kind of crazy. Well, the outcomes are crazy, right? Like nobody. You don't. It's a bit like I think it's like elite athletes, right? Like you're running the 10, the sub 10-second 100 meters. It really matters if you're doing, I've forgotten what that like, but like the difference between like 9.5 seconds and 9.6 seconds is enormous, and even the difference between 9.59 and 9.6 is really big in an AI agentic world, right? Because you get these complete takeoffs, and we've seen this already, and we're seeing it live.
We'll hope for your sake, it's a 10x from here from OpenAI, and for all of our sake, that there are more $100 billion companies to be founded. Gentlemen, thank you for the time. Thank you all for being part of the conversation, and onwards and upwards.
Thank you.